If you think silver at $77 is just another number on a screen, you are missing what may be one of the most important positioning shifts unfolding in the financial system right now. As of today, Sunday, 15th February 2026, the surface narrative says volatility. The deeper data says something very different. This is not hype. This is not a retail-driven story, and this is not speculation wrapped in dramatic language. Every element discussed here is grounded in publicly available institutional data. What matters is not the daily fluctuation. What matters is who is stepping in while others are stepping out. Silver closed its most recent session at $77.41 per ounce. That number alone does not sound historic, but markets are not defined by price levels alone. They are defined by behavior around those levels. The real question is this: are the largest financial institutions in the world quietly positioning for a higher move in silver while retail investors focus on short-term fear? To understand what is happening, you have to begin with the difference between emotional reaction and institutional strategy. When silver falls sharply and then stabilizes in the mid-70s, most individual investors feel uncertainty. They look at portfolio losses. They question whether they should reduce exposure. That reaction is predictable. It is human. Institutional participants do not operate from emotion. Major banks and commodity desks employ quantitative analysts, macro strategists, metals specialists, and risk managers whose sole responsibility is identifying pricing inefficiencies created by forced selling. When silver drops quickly over a short time frame, institutions do not immediately interpret the decline as a collapse. They analyze whether leverage-driven liquidation has temporarily pushed price below underlying equilibrium. The recent price structure in silver does not resemble systemic breakdown. In a genuine panic, you would see cascading margin liquidations, expanding bid-ask spreads, thinning liquidity, and relentless follow-through to the downside. What has occurred instead is sharp volatility followed by stabilization near $77. In professional trading language, that stabilization suggests absorption. Absorption occurs when aggressive selling is met by sufficient buying interest to prevent further decline. When absorption develops at a defined level, it implies that capital with deep liquidity is taking the opposite side of retail-driven selling. The entities capable of absorbing sustained silver selling are not small traders. They are global banks, sovereign funds, and large commodity-focused hedge funds. This dynamic is observable through volume concentration, order flow behavior, and changes in futures open interest. The primary U.S. venue for silver futures is the COMEX division of the Chicago Mercantile Exchange. COMEX pricing functions as the global reference benchmark. Positioning data from this exchange reveals what different participant categories are doing beneath the surface. Every week, the Commodity Futures Trading Commission publishes the Commitments of Traders report. The report separates positions into commercials, managed money, and non-reportable traders. Commercials include banks and industrial hedgers. Managed money includes hedge funds and commodity trading advisors. Non-reportables represent smaller speculative participants. Recent CFTC data reveals a meaningful shift. Managed money participants have reduced their net long exposure in silver futures. That means hedge funds have been trimming bullish bets or increasing short positions. At the same time, commercial participants have reduced their net short exposure. When commercials become less net short while managed money reduces longs, it creates a configuration that historically has preceded reversals. This pattern is not coincidence, it is structural. When leveraged speculators exit long positions during declines, they must sell contracts. Those contracts do not disappear. Someone must take the other side. When commercial participants absorb that selling, institutional capital is effectively accumulating at lower prices. The stabilization near $77 reflects this dynamic. It is not retail confidence holding price steady. It is institutional absorption beneath visible volatility. Now consider the broader macroeconomic environment in the United States in early 2026. The Federal Reserve remains in a complicated position. Inflation has moderated from peak levels, but remains above the long-term 2% target. Economic growth shows signs of deceleration, but not collapse. The federal funds rate remains elevated compared to the near-zero policy era following the 2008 financial crisis. Higher interest rates create opportunity costs for non-yielding assets like silver. Investors can earn yield in treasury bills or savings instruments. That dynamic explains some of the pressure precious metals face when expectations for rate cuts are delayed. But institutions do not make commodity decisions based on the current policy rate alone. They model forward scenarios 6 to 18 months into the future. The critical question is whether economic growth slows sufficiently to force eventual rate reductions while inflation remains sticky. That scenario, slower growth combined with persistent price pressures, has historically supported precious metals because it compresses real yields and erodes purchasing power. Several major Wall Street banks have published research in early 2026 indicating that probability of such an environment has increased. JP Morgan, which operates one of the largest precious metals trading desks globally, maintains a constructive medium-term outlook on silver. Goldman Sachs continues to recommend overweight exposure to precious metals within diversified commodity allocations, citing constrained supply and durable industrial demand. These are institutions managing trillions of dollars and participating directly in both physical and derivative markets. When published research from these banks aligns with measurable positioning changes in futures data, the convergence matters. Now shift attention to the physical market. Silver demand is not dependent solely on investor sentiment. It is driven by industrial output, renewable energy expansion, electronics manufacturing, and technological adoption. In 2025, global silver demand exceeded mine supply for the fifth consecutive year, creating a documented structural deficit according to the Silver Institute's annual report. A structural deficit means global consumption exceeds annual production. The gap must be satisfied by drawing down above-ground inventories or recycling material. COMEX registered inventories, representing deliverable silver against futures contracts, have declined substantially from earlier decade highs. When registered inventories decline while open interest remains significant, the ratio of paper claims to physical metal increases. That ratio can amplify price sensitivity in either direction. London Bullion Market Association vault holdings have also trended lower over the past 2 years, reinforcing the tightening narrative. Silver supply is inherently constrained. Approximately 70% of global silver production is generated as a byproduct of mining copper, zinc, and lead. That means silver output cannot rapidly expand simply because silver prices rise. New primary silver projects typically require 7 to 10 years from discovery through permitting and construction to reach full production. This supply inelasticity shapes institutional analysis. When demand persists and supply cannot respond quickly, price pullbacks driven by financial liquidation rather than demand collapse often prove temporary. At $77.41 per ounce, silver remains above most primary producers' all-in sustaining costs. Mining operations remain profitable, yet prices are not high enough to trigger widespread industrial substitution. From an institutional perspective, that is a constructive zone, elevated enough to confirm structural strength, controlled enough to preserve demand integrity, and as of today, Sunday, 15th February 2026, that is precisely where silver stands. Another critical dimension of this story lies in the exchange-traded fund landscape, because ETF flows represent one of the clearest windows into investment demand for silver. The largest silver ETF in the world is the iShares Silver Trust, trading under the ticker symbol SLV. This fund holds physical silver bars in secured vaults to back shares that trade on stock exchanges, giving both retail and institutional investors exposure to silver prices without directly handling physical metal. When silver experiences sharp declines, funds like SLV frequently see outflows. Investors redeem shares. To meet those redemptions, the ETF must sell physical silver from its holdings. That selling can reinforce downward price momentum. It becomes a feedback cycle where falling prices trigger redemptions, redemptions trigger physical sales, and physical sales apply additional pressure to price. However, institutions interpret this dynamic differently than emotional traders. They understand that when ETF outflows begin to decelerate and eventually stabilize, it often signals exhaustion of weak hands. Historically, some of the strongest silver advances over the past 2 decades began shortly after peak ETF redemptions. Once selling driven by fear is completed, supply pressure eases, and the remaining holders tend to be structurally stronger. Major banks track ETF flows daily through data providers and direct communication with authorized participants, the institutions responsible for creating and redeeming ETF shares. If ETF outflows are slowing while silver price stabilizes near $77, that pattern aligns more closely with late-stage capitulation than early-stage breakdown. The options market provides another layer of information that institutional desks analyze carefully. Silver options trade on COMEX and offer insight through metrics such as implied volatility, put-call ratios, and volatility skew. Implied volatility reflects how much price movement options traders expect over a given time frame. During a sell-off, implied volatility typically spikes as fear increases. When volatility begins compressing while price stabilizes, it suggests that panic conditions are fading. The put-call ratio indicates whether traders are purchasing more downside protection through puts or more upside exposure through calls. An elevated put-call ratio signals crowded bearish positioning. When too many traders lean in the same bearish direction, markets become vulnerable to short covering rallies if even modest positive catalysts appear. A short covering rally occurs when traders who sold futures contracts or purchased puts must reverse positions as prices stop declining or begin rising. That reversal creates buying pressure. Silver has historically exhibited violent short covering phases because its market capitalization is smaller relative to gold or major equity indices. Concentrated positioning shifts can therefore move price rapidly. The US dollar remains a central variable. Silver is globally priced in dollars. When the dollar strengthens, it acts as a headwind by making silver more expensive for foreign buyers. In early 2026, the dollar index experienced periods of strength as interest rate differentials favored the United States compared to Europe and Japan. Dollar strength can reduce marginal international demand, but currency trends are cyclical. If other central banks tighten policy, or if the Federal Reserve begins easing later this year, interest rate differentials could narrow. That would reduce upward pressure on the dollar. The fiscal position of the United States also shapes longer-term currency outlook. Federal debt exceeds $36 trillion. Annual budget deficits remain above $1 trillion. Institutions modeling currency trajectories 6 to 12 months forward recognize that prolonged dollar strength is unlikely to persist indefinitely under such conditions. A stabilization or weakening dollar would remove a significant macro headwind for silver. Geopolitical considerations add another layer. Trade tensions between the United States and key global partners continue influencing supply chains. Tariffs and countermeasures impact raw material costs, including industrial metals. When manufacturers anticipate potential disruptions, they often accelerate forward purchasing to secure inputs at known prices. Banks facilitating these hedging transactions observe corporate demand flows directly. When solar manufacturers or electronics firms hedge future silver purchases due to trade uncertainty, that order flow becomes visible to the executing banks. Although proprietary, it informs institutional expectations regarding forward demand. The Inflation Reduction Act, enacted in 2022, allocated hundreds of billions of dollars toward clean energy expansion. The subsequent build-out of domestic solar manufacturing capacity has materially increased U.S. silver consumption. Even amid political debate surrounding aspects of this legislation, capital investments already made create momentum that continues regardless of near-term policy adjustments. The distinction between financial selling and fundamental demand destruction remains critical. Financial selling occurs when leveraged traders liquidate positions due to margin pressure or risk mandates. Fundamental demand destruction occurs when end users permanently reduce consumption because prices are unsustainable or substitutes become viable. At $77.41 per ounce, there is minimal evidence of meaningful demand destruction within industrial sectors. Solar producers, electronics manufacturers, and automotive suppliers continue purchasing silver. That suggests recent price declines were driven largely by financial flows rather than deteriorating end-use demand. Returning to the commitments of traders' data, deeper analysis reinforces this interpretation. Commercial participants include major banks such as JP Morgan and HSBC, along with mining companies and industrial consumers hedging production or usage. When commercial net short exposure declines, it indicates reduced bearish posture. Historically, extreme commercial net short positions have aligned with major market tops. Conversely, unusually low net short levels have preceded rallies. Commercial participants possess superior insight into physical market conditions. Their positioning reflects informed judgment rather than speculative momentum. In the weeks preceding stabilization near $77, managed money net long positions declined sharply. Hedge funds reduced bullish exposure. Simultaneously, commercial net short positioning contracted. This configuration, speculative washout combined with commercial absorption, has historically preceded significant silver advances over the past 15 years. For example, during the 2008 to 2011 silver bull cycle, interim corrections displayed similar positioning shifts before renewed upside momentum emerged. It is important to recognize that COTE data does not provide exact timing signals. It reveals positioning potential. It measures stored energy rather than ignition. The gold to silver ratio provides additional context. Over the past 5 decades, the long-term average ratio has hovered near 60 to 1. In early 2026, with gold above $3,000 and silver at $77.41, the ratio stands near 39 to 1. That level represents meaningful compression compared to extremes above 80 during 2020. In prior bull markets, the ratio compressed further as silver outperformed gold during later phases. In 1980, the ratio approached 17 to 1. In 2011, it compressed near 31 to 1. If the present cycle follows historical tendencies, further silver outperformance remains plausible. Institutional arbitrage desks monitor this ratio continuously and sometimes position for convergence when it diverges from historical norms. The silver leasing market adds another signal. Central banks and commercial banks lend physical silver in exchange for lease rates. Rising lease rates indicate increased demand to borrow metal. Periodic lease rate spikes in recent months suggest incremental tightening in physical availability. When rising lease rates coincide with declining COMEX registered inventories and reduced LBMA vault holdings, the narrative of tightening physical supply strengthens. And that tightening, while not always visible in daily price moves, continues developing beneath the surface. The London over-the-counter silver market represents another crucial layer in understanding institutional positioning. Most global wholesale silver transactions occur on a loco-London basis, where large bars stored in London vaults are traded between banks, refiners, and institutional buyers. Unlike COMEX, the London market operates with less public transparency. However, the London Bullion Market Association publishes vault holding data that provides insight into total available inventory within the system. LBMA vault holdings of silver have been trending lower over the past 2 years. When declining London inventories align with shrinking COMEX registered stocks and periodic increases in silver lease rates, it strengthens the conclusion that the physical market is tighter than headline spot prices may suggest. When multiple independent indicators converge in the same direction, institutional analysts take notice. The topic of a short squeeze in silver has captured public attention before, particularly during the early 2021 retail-driven campaign. That effort ultimately faded because the silver market is structurally larger and more liquid than a single equity. Margin requirements were adjusted. Available inventories at the time provided sufficient buffer. Coordinated retail participation lacked the scale required to overwhelm supply conditions then in place. However, the structural backdrop in early 2026 differs meaningfully from 2021. First, overall inventories are materially lower today than they were 4 years ago. The buffer of deliverable metal has diminished. Second, the structural supply deficit has now persisted for 5 consecutive years, reinforcing the tightening narrative. Third, institutional positioning appears more aligned with gradual accumulation rather than skepticism toward higher prices. None of this guarantees a squeeze outcome, but it does imply that upside risk is being evaluated differently within banking circles compared to previous cycles. Market microstructure within silver futures also influences price dynamics. Each COMEX silver futures contract represents 5,000 ounces. A $1 movement in price corresponds to a $5,000 change in contract value. Because margin requirements typically represent only a fraction of total contract value, leverage within the system is substantial. During periods of reduced liquidity, such as overnight trading sessions or holiday intervals, relatively small shifts in positioning can generate outsized price moves. Banks function as clearing members for most futures transactions. They observe client margin stress, forced liquidations, and positioning adjustments in real time. When hedge fund clients have already been forced out of leveraged long positions due to margin calls, a key source of additional selling pressure is removed. The removal of that selling overhang does not automatically create immediate upside, but it changes the balance of probabilities by eliminating one of the primary forces driving price lower. The U.S. Treasury market exerts indirect but powerful influence through real yields. Real yields are calculated by subtracting expected inflation from nominal Treasury yields. When real yields are high, the opportunity cost of holding non-yielding assets such as silver increases. When real yields decline, that opportunity cost diminishes. In early 2026, real yields remain positive. However, signs of moderating growth combined with persistent inflation pressures suggest that the gap between nominal yields and inflation expectations could narrow. Even modest compression in real yields can redirect capital flows. Money market funds in the United States held over $6 trillion in late 2025. That represents an enormous pool of capital allocated to short-duration instruments. If interest rate expectations shift or diversification demand increases, even a small reallocation toward precious metals could significantly influence silver pricing because the silver market is relatively small compared to bond and equity markets. This asymmetry between potential capital sources and market size explains why silver has historically exhibited explosive upward moves when sentiment turns. Institutions understand this structural dynamic and position accordingly. The mining sector reinforces the supply narrative. Major silver producers such as First Majestic Silver Corporation and Pan American Silver Corporation have reported operational challenges limiting rapid production growth. Declining ore grades, rising energy costs, labor constraints, permitting delays, and water availability issues in key jurisdictions, including Mexico and Peru, constrain expansion. Banks financing mining companies receive detailed engineering assessments and production forecasts. Their internal models often confirm that substantial supply growth over the next 5 to 7 years is unlikely. Meanwhile, industrial demand growth between 3 and 5% annually continues. As cumulative deficits draw down available inventories year after year, the structural floor beneath silver prices gradually rises. HSBC, one of the largest operators of LBMA vaults, has direct visibility into global physical flows. China remains a dominant force in solar manufacturing, requiring large quantities of silver. Additionally, Chinese consumers facing real estate market instability have increased interest in alternative stores of value. India continues to represent strong physical investment demand as well. The combined effect of Chinese industrial consumption, Indian physical buying, and ongoing structural deficit creates a durable demand foundation observable to institutions monitoring global flows. Seasonality adds incremental support. Historically, late winter through spring has shown constructive tendencies for silver as industrial activity accelerates following seasonal slowdowns and institutional portfolios rebalance during fiscal year transitions. Seasonality alone is insufficient to drive trends. But when it aligns with supportive positioning and tightening supply conditions, it contributes additional weight. Psychology remains central. Behavioral finance research from institutions including the University of Chicago and Yale has documented how loss aversion, recency bias, and herd behavior influence investor decisions. Loss aversion causes the pain of a decline to feel disproportionately larger than the satisfaction of gains. Recency bias encourages investors to extrapolate recent weakness into future expectations. Herd behavior amplifies these tendencies. Retail participants often sell near lows when anxiety peaks. Institutional desks, evaluated on risk-adjusted performance metrics rather than emotion, frequently act during those periods of maximum pessimism. The critical question for investors observing silver at $77.41 per ounce is not whether they can precisely identify the ultimate bottom. Even institutions rarely achieve perfect timing. The more relevant question is whether the alignment of positioning data, physical supply trends, macroeconomic conditions, and institutional research suggests that risk-reward over a 6 to 12-month horizon is favorable. At present, evidence tilts toward accumulation rather than distribution. This does not eliminate volatility. Silver markets remain inherently volatile due to leverage and comparatively smaller capitalization. But volatility does not necessarily imply sustained decline. In the weeks ahead, several indicators will provide confirmation or contradiction. Weekly CFTC commitments of traders' reports will reveal whether commercial absorption persists. Daily ETF flow data will show whether redemptions stabilize. Federal Reserve communications will shape expectations regarding rate trajectories and real yields. Dollar index movements will clarify currency headwinds. COMEX inventory updates will indicate whether registered stocks continue declining. Earnings reports from major silver miners will provide insight into supply constraints. Each data stream contributes to the broader assessment. Markets operate in probabilities, not certainties. Intellectual discipline requires acknowledging uncertainty while evaluating evidence objectively. As of Sunday, 15th of February 2026, the convergence of positioning shifts, tightening physical supply, macroeconomic context, and institutional research suggests that silver at $77.41 may represent stabilization supported by underlying structural forces rather than the beginning of sustained weakness. Understanding how banks analyze data, monitor flows, and position capital offers a framework for interpreting what comes next. Follow the positioning, watch physical inventories, monitor real yields and currency dynamics, distinguish between financial noise and structural fundamentals. Institutions appear to be doing exactly that, and if the coming months unfold consistent with current evidence, this quiet stabilization near $77 may eventually be recognized as the base from which the next significant move in silver began.